Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today I thought I'd talk about 7 often missed tax deductions. This recent tax overhaul is really taking some tax breaks away, so it's a good idea to really take a hard look at some of the things that you're able to deduct this year that you may not be able to deduct in the future. There was an article written by Selena Marangian, that's Maranjian, which was published February 25th on the Motley Fool. And this highlights things here that I think that 7 tax deductions that many people and even some paid preparers overlook. So let's talk about those. And the first one is contributions to a traditional IRA. Now, what we're talking about here is that if you're not covered by a pension plan at work, like a traditional 401k or a 403b, you do have the ability to make a contribution to a individual retirement account. Now, what you need to know is the annual contribution limit for IRAs in both 2017 and 2018 is $5,500, plus another $1,000 for those of you that are 50 or older. Now, if you reduce your taxable income by $5,500 and you're in the 24% tax bracket, you avoid $1,320 in taxes. Now, that's just federal taxes. And the best part of these is that this isn't something you had to have done already. You can still have time to make these contributions before April 17, 2018 for 2017 year. Now, one of the things I will tell you, if you're going to do that, make sure that whoever you make that investment with understands that this is for the 2017 year. You also want to make sure that you tell them it's a traditional IRA. What you don't want to do for this particular deduction is do a Roth IRA. There are efficacies to doing the Roth IRA, and I've talked about those in other broadcasts, but this, what we're talking about, is a traditional IRA. So that's the first thing. Next thing, job search expenses. This is one of the many things that the GOP tax overhaul eliminated in 2018. So if you recall, on your Schedule A, there was a section of the Schedule A called miscellaneous itemized deductions subject to a 2% adjusted gross income floor. Well, this is getting axed in the new tax law, but for 2017, this is still something you can use. So here's the scoop. Job search costs may be deductible if you're looking in the same field that you currently work in and if you're not embarking on your first career. This comes under, like I said, the cost of miscellaneous expenses. Now, these are subject to that 2% limitation. So, for example, if you make $60,000 a year, you would multiply that by 2% and come up with $1,200. Those would not be deductible. So in order to take any of those deductions, you'd have to have spent over $1,200. Now, among these expenses that qualify for these job search are transportation to and from interviews, the cost of printing resumes and mailing them out, and food and lodging costs if your search is taking you overnight somewhere. Just make sure you've got all your documents and your receipts put together. The next area that is getting a major overhaul with the 2018 tax, and that is the area of moving expense. Now, the only one that's going to be exempt from this moving forward are those who are in the military. So if you were able to move this past year and you look at deducting your moving expenses, such as the cost of hiring a moving company or renting a truck, if you're moving in order to take a new job or because your job changed locations, then you will qualify. But here's the caveat to that. Your new job site must be at least 50 miles further away from your old home than your old job was, and though you may not have moved earlier than a year before starting to work in the new location. You must also continue to work a full-time job for 39 weeks during the first year after the move. So if you want to find out more information about that, you can look at IRS publication 521. But this is the last year to take advantage of those moving expenses unless you're in the military. The next thing is charitable contributions. And I've had a lot of clients in already this year, and there's a lot of misinformation going on about charitable contributions. They have not eliminated charitable contributions moving forward, but what they've effectively done by increasing the standard deduction is really made it much more difficult for people to claim charitable contributions, because I'm not 100% sure that most people are going to be able to itemize. Now, it just depends on your particular circumstances. But the thing is, you need to make sure of is that if you're donating them to a qualified charity. So it can't be, somebody that you know or something like that. There needs to be an order set up where this is actually a charity. The thing you need to make sure of is that you have documentation for this, such as a receipt or a canceled check with a date and amount. Now, one of the other things you want to be careful of, and I ran into this week, is if you're doing any kind of goodwill or non-cash donations, if you're going to donate in excess of $5,000, and this isn't talked about a lot, and regardless of how many trips you make in a year, if you donate a total of more than $5,000, you're going to have to get a certified appraisal done on any of those things. So, for example, let's say that you decide to do a spring clean out and you donate $1,500 to the Goodwill, and you do another clean out maybe in the middle of the summer and then a third one in the fall. A lot of people are under the misconception that the total can't be more than $5,000 per donation, but actually, having done some research this week, if you go over $5,000 in the current year of the same type of goods, you'd have to get a certified appraisal. Next thing, this is state and local taxes. This is another one that's going to have some changes going into 2018 where they're going to cap the amount that you paid. So one of the things you want to make sure of is when you're doing your tax return, make sure you take a deduction for your state and local taxes as well as your property taxes. Because beginning with 2018, that is going to be limited to $10,000. Now, another area, and this is one of those things that's not really changing by moving away, but it's another one of those itemized deductions that most people may not be able to qualify for moving forward, and that's medical and dental expenses. They're still potentially deductible next year and beyond, but the rules are changing a little. And what that means is right now, you can deduct medical expenses that are in excess of 10% of your adjusted gross income. So for example, if your adjusted gross income is $80,000, then you'd only be able to deduct those medical expenses which are greater than $8,000. Again, so then once you get over that $8,000, then whatever is above that $8,000 would count. So if you're not able to itemize because of the new standard deduction, these may not be of much of a value for you. So something to consider. And the final one they mentioned in this article is losses from investments. And this brings up another point that I try to explain to my clients. You know, you're able to deduct losses in your portfolio. So one of the things I recommend to all of my clients is a meeting with your broker sometime close to the end of the year where you have a discussion about, what's in your portfolio. I have a lot of clients that because of previous decisions in investing are having an unallowed or a carryover loss. And the issue of that is you can only deduct up to $3,000 per year. So one of the things I mentioned to my clients is, meet with your financial advisor and tell them, hey, your accountant said that you've got unused capital losses that you can offset against capital gains. A lot of my clients take advantage of that. They'll tell their broker, listen, Ralph said I've got $12,000 in losses that I haven't been able to deduct. Are there any winners in my portfolio that I could sell and basically make income tax free? But it's something you've got to sit down and plan a strategy with your financial advisor and do it prior to the end of the year. So this would be really advice for 2018. But it's something you need to discuss with your tax preparer or your accountant and make sure that you set up that meeting with your financial advisor so you don't run into any issues. Well, I hope these 7 things of often missed tax deductions work for you, and we'll talk about them more in the future.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.